Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn and Kansas City wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago wheat. The dominant pattern here had been, and maybe still is in some ways, the dark blue mid-February to mid-June last year bearish shift pitchfork. The dark blue upper time, currently at 541, had been previously tested and breached, most recently for about the 5th time, and that was yesterday. The recent base of action from whence the move up originated had been the combined 38.2% absolute Fibonacci line and the August 24 low at 521 for both. This wasn't the low for the recent move, that was the bright green lower trend line, currently at 512 even, but the core support was the combined August 24 low and the 38.2% absolute Fibonacci line. What was interesting about the whole move since mid-December last year was how prices formed a reverse head and shoulders bottom or triple bottom, which anyway the reverse head and shoulders bottom is a derivation of, and how we have moved since. 2 weeks ago, on the same Wednesday that prices broke higher over the dark blue upper time, was when the market also broke up over the bright red neckline, currently at 547 even, and that's of the reverse head and shoulders pattern. Now, prices have not stabilized over this bright red neckline since. We're over it now, but we haven't stabilized over it. But I did say 2 weeks ago, and it's a long piece, and I quote, "This move up has given me an opportunity to lay out some targets above for this pattern. And thus a primary target X would be up in the 560 area, with a secondary hard to reach target X1 up in the 567 area. So what have we left in a way that could alter this idea? Well, there was something that came to light by my looking at longer term charts for my annual review earlier in January. It is a March/October 2025 to date bright green descending triangle pattern, which you can see on my daily chart highlighted in bright green. Obviously, currently that's 512 even to 552 3/4. We're not too far away from the bright green upper trend line today. We're also quite a way along this bright green descending triangle, enough that we are very likely to have false breaks from it, so please be aware." End of quote. I also added at the time, and I quote, "I'm not ready just yet to lay out targets, as we have not broken this pattern as yet, or even to lay out potentials, but we are quite advanced along the pattern. And as I said 2 weeks ago, and I quote, I suspect this may rival the dark blue bearish shift pitchfork for primacy in determining the future of this market." End of quote. Since then, I have posted on my daily chart a primary target X up in the 560 area and a secondary hard to reach target X1 up in the 567 area. These still apply, though the market, well, until today, seems to be taking its own sweet time in trying to get up there. I'll also start considering looking at the action since mid-December last year as a possible bull channel in construction. My final point again is something I saw from my longer-term monthly charts earlier in January. It is a May/July 2023 to date bear channel. The lower bear channel line is below the bottom of my daily chart, but you can see part of it in the lower left-hand side of my daily chart. The upper bear channel line is close to the top of my daily chart, and it's currently at 624 even. This is one to just keep in mind for now, nothing more than that. Chicago corn. Above the market, as I have said repeatedly, sits the 50% Fibonacci line for 2025 at 454 3/4, which, as I've said also here repeatedly, and I quote, looks a seemingly formidable resistance, because just above that is the very shallowy bearish bright red lower trend line, currently at 455.5, to the July 23 to January 24 descending triangle. End of quote. These two managed to cap prices back in November last year, and again in between Christmas and New Year, and once again in early January this year. So as I said earlier, formidable. The latest incident of prices trying up to those two resistances had the outcome of the market falling like a stone from a combined key reversal down and bearish long black Mariposa. In the fall, prices broke down through and have so far stayed below the green short medium moving average, which is currently at 442 3/4. The November 2020 high at 439.5, just about, which in truth I previously said doesn't look like much support right now. Then the flatlining mauve medium moving average, which is currently at 441.5, as well as the slowly declining gold long moving average, currently 431.5. Though the market has indeed pushed it above this one since and is actually using it as a base of action for the moment. The fall in early January only stopped at what I had called 8 weeks ago, and I quote, the important 50% absolute Fibonacci line at 425, which in turn led to the October low at 425.5. Any such possible moves lower will be the ones to watch, as it may well determine the future health of this market, as prices seem right now to be willing to just hold and maybe test the resolve of the overhead seemingly formidable resistances. End of quote. Because of the 50% absolute Fibonacci line, prices chose another way by making a small bull channel over most of January. But, as can be seen as we entered February, the market was not strictly happy with that either. We've exited this small bull channel, but also decided not to fall again, not yet at least, nor to rise. All this does not mean it's the end of the potential move lower, not yet. You see, we could be looking at the whole of the mid-January today action as a possible bear flag, and having the mauve medium moving average capping prices as it has done, and possibly, maybe, retesting the gold long moving average support at some point. Well, that would tie in those things with such an idea. If such an idea were to come true, then we could be looking at a move down in between the December 2020 low at 414.5 and the February 24 low at 408 3/4. It all depends if we can start to head lower, and soon, allowing me to draw a bearish pitchfork to show the direction of attack lower. But I think it must be soon, very soon, otherwise we will have something else. To get a better idea of some of the larger forces at work here, I would like to look at my longer term charts. Now, before we go any further, I would, for the purposes of this discussion right now, like to set aside target X1 below at 335. This relates to the lopsided head and shoulders top pattern dating from 2021 to 2023, and I'll refer to it should we get closer, but for now I'd like to concentrate on what new things we have for 2026. Thus, I said in my annual long-term video commentary published in January, and I quote, and it's a bit of a quote, so what new feature have we seen developing through 2025? Well, I'd looked at the whole 2023 to date action as a possible double bottom in formation. But I think the market's having doubts about this pattern right now. You see, to form this, we would have to move up towards the 2025 high around the 61.8% absolute Fibonacci line and the gold 5-year moving average, and breach higher, which is a considerable order to fulfill. Yet in the meantime, we have the mauve 3-year moving average bearing down on the market. And as we saw in part back in February 2025, this can be significant bearish pressure. However, just that would not be enough for me. And this is where the action over November and December 2025 come in. Both these months have ended up as indecisive patterns, as if the market can see this mauve 3-year moving average bearing down on it and is already flinching. I'm not sure at this stage whether prices could really handle this 3-year moving average hitting and mixing with it, but we still have very few months. One final, and I suppose an indirectly related point to the double bottom idea, plus this also relates to an earlier target I spoke about. I said last year, so that's back in the start of 2025, I said last year, and I quote, one housekeeping point and one point to watch out for. In housekeeping, I think by this time next year I'll have likely retired the secondary target X1 below, given the recent actions. End of quote. Well, I've decided to keep this target X1 still on my monthly chart for one more year just in case. End of quotes. That's the end of all the quotes. I will only add that the 3-year moving average above is now at 461 even. Kansas City wheat. The rise we saw since just before Christmas last year was and is being capped by erosion from the March 24 low at 551, and more so by the dark blue extension currently at 554, and 2 weeks ago by the March 21 low at 559.5. But it has continued to rise, and in the process has formed a reasonable looking November 25 to date bright red bull channel. And that's currently 539 even to 570 3/4. The market has breached over the dark blue lower trend line, but as yet has not stabilized over it, in part because prices have also been busy in tackling the March 21 low. However, once beyond that, there is only the constraint of the bright red upper bull channel to stop it rising within a fairly clear area all the way to the July 21 low at 578. It'd be interesting to see, 1, if it does, and 2, how it does it, if it does. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.